In this video, we're going to take a look at the price of gold, what drives it, and why is it such a popular market with traders. Hello, I'm David Jones from Capital.com, and this is the latest in our series where we look at popular markets with traders. So this time around, we're going to take a look at the gold price. It is the most widely traded of the precious metals, very popular market with traders around the world. So let's start taking a look at what drives this market, how can you trade it with Capital.com, and the typical volatility. Let's get started. So, what is the gold price and why is it popular? Gold has always been the most popular precious metal amongst investors, and it's also widely traded by plenty of traders. From an investment point of view, it's traditionally been used as a hedge against inflation. So when prices are rising in the wider economy, some investors have used gold as a way of offsetting that, or also as a store of value in times of market turmoil. So for example, when stock markets are falling, some investors would move their assets into gold because it was seen as a safe destination. It could also be viewed as just another currency like the euro or the pound. The price of gold typically moves opposite to the US dollar. So if the US dollar is strengthening, usually the price of gold will be falling, and vice versa. So how do you trade gold with Capital.com? You trade contracts for difference, CFDs, which is probably a term you're familiar with on the gold price. It just tracks the price of gold up and down. You trade using leverage. Leverage is very popular with short-term traders because it means that a small amount of money can control a much bigger financial position. So traders will use this as a way of magnifying their profits. But of course, when you're using leverage, you have the potential for bigger profits, but also the potential for bigger losses. So it's very important to use risk management controls such as stop losses to make sure you're not going to take too big a hit when using leverage. And with CFDs, you can trade in both directions. You can trade long and short. So if you think the price is going to go up, you'd buy first using CFDs, you're long. If you think the price is going to fall, you'd sell first using CFDs, you're short. You're hoping to profit from a drop in the price. And here's a quick look at the sort of volatility you can see in gold. This is why it's popular for traders. This is over the last 12 months or so. So it's traded as high as $1,350 an ounce. That's what the value of an ounce of gold was back in April 2018. Then it slipped as low as $1,160 an ounce by August 2018, then bounces back, trades to where we are now. And let me just make this a short-term chart so we can see the typical volatility over a couple of days. So we can see even over the last 2 to 3 days, the price has moved from 1268 up to sort of 1276 levels. So there's this reasonable amount of volatility even over the short term, which is a reason why gold is such a popular market with many traders. So you can see that gold does have a few uses. You know, it's seen as a hedge against inflation, a place of safety in falling markets, and also just another currency because it moves inversely to the US dollar. Many traders will trade this using CFDs. The benefit is you can trade the market in both directions. You trade using leverage, which helps magnify your profits. But of course, hand in hand with that goes the risk of increasing your losses. So as I said, it's very important to use risk management controls such as stop losses, but you can read more about CFDs, contracts for difference, on the Capital.com website. That's our short introduction video on gold. Over. So from me, David Jones, and Capital.com, good luck with your trading.